And so seeing a gap, I thought we'd fill it. It's the classic, I see a problem, let's build a solution.
Mhm.
And as I was coming up the curve on these, let's say, I would share with colleagues, friends that are investment experts in the field, derivative experts, here's what's going on in these buffered ETFs. And all of them would say, you have to be kidding me. Like, they're doing what? And that kind of started me thinking I should build something because I think I can help. That's really the basis for this. And so it goes back to 2021 when I began working at Wealth Plan Group in Omaha. They had a buffered ETF portfolio, or a portfolio of buffered ETFs, several tickers from various month expirations. And they were treating it as a buy and hold. And what I came to understand is that buying and holding these isn't the best. I don't think of it as best practice. So I began more actively monitoring and trading them. And then I saw the investment results we were getting, which were, I'd call them appreciably better than buy and hold, and appreciably better than if you just had a ladder.
Let's go boom.
Hello, everyone, and welcome to What's the Alternative, the show where we dive deep into the nuances of alternative investments with the practitioners that manage them. I have had a lot of discussions in the past where we have touched on the idea of buffered ETFs. And anyone who follows me knows that I am not the biggest fan. Our previous episode with Corey Hofstein, we touched upon it a little bit. And at the end of that episode, Corey and I had a little chat and said, wouldn't it be cool if I could get someone on the pod who was a buffered ETFs expert? And I immediately thought to myself, who do I know that likes buffered ETFs? Like, who do I know? And I thought, I do know somebody. I know my old boss from Russell has been posting a lot on LinkedIn about buffered ETFs. Maybe I should go talk to him. And that led to me reaching out to Erik Ogard, my former boss at Russell Investments. He is the driving force behind BufferLabs, which is a company that offers really good analytics and research on buffered ETFs, as well as manages and has an ETF product in the market related to buffered ETFs. He draws on his extensive experience as a portfolio manager and investment professional. But starting in late 2021, while managing a portfolio of buffered ETFs, he saw that they could be really tricky for advisors. They're really complex. And given his career has been spent in senior investment roles, Erik thought maybe there was a clearer way to evaluate these products. And much to my surprise, Erik turned out not to be the cheerleader for buffered ETFs that I thought. His views are actually much more nuanced and important. And he's going to give us a masterclass on buffered ETFs today and hopefully even school me. So without further ado, I'd like to welcome Erik Ogard to the pod. Thank you for coming.
Thank you, Shane. It's a real pleasure to be here.
It's been a very long time. In fact, I even mentioned when I reached out to you, I was like, I feel like it's been almost 20 years since we've had like a real conversation. And it has. But we had another former Russell colleague on the pod a little while ago, John Liddington. So I feel like this is just a Russell reunion this last few months. 2026 has turned out to be a Russell reunion. So why don't we just dive right in? Tell us a little bit what prompted your desire to go all in on educating and providing research for advisors on buffered ETFs.
Yeah, I think the greatest impetus is that I think I just felt like there was lack of understanding for how the instruments behave, and if you're going to invest in them analytically, what they require. And so seeing a gap, I thought we'd fill it. It's the classic, I see a problem, let's build a solution.
Mhm.
And as I was coming up the curve on these, let's say, I would share with colleagues, friends that are investment experts in the field, derivative experts, here's what's going on in these buffered ETFs. And all of them would say, you have to be kidding me. Like, they're doing what? And that kind of started me thinking I should build something because I think I can help. That's really the basis for this. And so it goes back to 2021 when I began working at Wealth Plan Group in Omaha. They had a buffered ETF portfolio, or a portfolio of buffered ETFs, several tickers from various month expirations. And they were treating it as a buy and hold. And what I came to understand is that buying and holding these isn't the best. I don't think of it as best practice. So I began more actively monitoring and trading them. And then I saw the investment results we were getting, which were, I'd call them appreciably better than buy and hold, and appreciably better than if you just had a ladder. So the thinking is, gosh, if I can do this as a newcomer, there's probably enough here in terms of distance, return gaps and things for a more informed view to add substantial value in the industry. And
Yeah,
so
and
that's
it's
really Genesis.
yeah, it's funny because in 2009, my favorite grad school professor was a gentleman named Dr. David Simon. May he rest in peace. He was a derivatives expert. And at that time, structured notes were all the rage, and I hated them with every fiber of my being. And the REA I worked for at the time loved them. And it took a lot for me to argue against why we should not be putting our clients in these structured products. I would do interviews with a niche publication called Structured Notes Daily, and the reporter would bring me the latest offering in the structured note, and they would get crazier and crazier. And I feel like that's been happening in buffered notes. I think most people have by this time see the rant I went on when Calamos introduced their Bitcoin buffer, which I just was, it was 0% downside with a 10% cap, which I guess today looks amazing. But
Hmm.
also, why? I mean, that's not why you would own Bitcoin. And I just felt like the whole trend in buffered ETFs needs an expert like you to come on and just talk about it. So let's start with how they work. I just touched upon structured notes. That's the influence on buffered notes and what led to their development. But talk to us about the history of buffered notes and, in essence, the basics of what they are, how they're built, and some of the main things that just right off the bat you need to be aware of.
Yeah, so they were introduced in late 2018 and commercially began to be adopted in about 2019. And since that time, I think they've grown to like over 80 billion AUM.
Mhm.
So there's been, after a period of testing, I think, fairly rapid adoption by the industry. And so you ask yourself, well, why did that happen? And I think of it as an investor utility. Like, they're doing something that people want or they perceive that they want. And so they've got market traction because some people can't stomach equity market risk, but they need, or I should say, unhedged equity market risk, but they need some exposure to capital appreciation. So they do it and they're uncomfortable. And the degree of discomfort with equity exposure varies from person to person. So it's a classic investor utility problem. But we know they're scratching an itch of some kind in the marketplace. And the basic structure is exposure to an underlying market. That exposure is achieved with a deep in the money long call option on the underlying, which pretty much provides one-to-one exposure to the underlying index, let's say the S&P. Now, the idea is people want some protection. So how do they achieve that? They achieve that through a structure called a put spread collar. And a collar implies you're on both sides of the current price of the market. And so there are two pieces to this. Put spread involves buying a put at some level below the current market. And the different issuers have different parameters for how far below they set those. And then there is a buffer zone where the put is effective until the endpoint at which the provider sells a put. So they buy a put here, sell a put here, create a buffer. That means they have exposure and market declines that are beyond the end of the buffer. Now, that's the downside part. To pay for that, options package, selling the put covers some, right? That's where they get the income, but they have to also sell a call that caps the return to the buffer strategy. And so those caps vary in size. I think there are a few. So that's the basic structure, a put spread collar. So selling a call above, buying a put, selling a put with some that creates a buffer. So is that part clear? Do you think
Yeah, but isn't there also some element of zero coupons involved here? In some cases, I know that's definitely the case in structured notes.
it depends on the provider? Are you saying exposure to a zero coupon bond to
No,
gain?
usually the zero coupon bond there to provide a guarantee, some level of we know at the end we'll have this money left to meet those buffers, as you explained with the caller, but also because a lot of them have a guarantee, at least in structured notes, sometimes there's a guaranteed outcome, like you'll never return less than X or something of that nature. Sometimes they include a zero coupon knowing that at the
There
end of the
are
day, they'll
those
get
types
that.
of elements out there, but the
Mhm.
vast majority of the ones that are equity market oriented are simply the structure I laid out for you.
Okay.
So there are always nuances. There's a proliferation. As you know, there are literally hundreds of these tickers out there now.
Mhm.
This is how the industry presents and talks about these buffer structures. Now, so they talk about the payoff as if that is certain.
Mhm.
The interesting thing is it's only certain on the expiration day.
Yes.
And so what our research and analysis shows, and we have this really cool chart that shows the theoretical option payoff, and then it shows the package of options payoff curve today.
Mhm.
And there's a dramatically different curve in the existing options package before expiration than there is on that last day. And so this is why practitioners talk about you have to buy it at the offering and hold it all the way to the reset and never sell it.
Right.
And we understand in order to talk about an outcome, a structured outcome, you have to talk about them that way. But if it's only true on the last day and these are daily liquid instruments that trade in the marketplace every day, our view is shouldn't you be talking about how they behave today,
Mhm.
not how they will behave 200 days from now? So a lot of our analytical approach is to bust these instruments open and graphically map the existing options package price today and show how it behaves over time relative to that approaching expiration date.
Yeah,
So,
so I think now we're gonna get into some weeds here that the audience is probably gonna need some handholding through because we're about to get complicated. And one of the things that everybody hears whenever we talk about options, especially when you talk to derivatives experts, is all of a sudden they start talking about the Greeks. And so to your point, when you start talking about the real-time option curves associated with the underlying options in these buffer ETFs, you can't do it without talking about the Greeks. So let's handhold our audience through some basics of what the Greeks are, because it's really imperative to understand some of that. And we don't have to go all the way down the rabbit hole. We're not expecting people to leave this podcast being and feeling like derivative experts. But I do think that it's important to have some basic understanding so you can ask the right questions when you're evaluating these things.
yes, when we talk about the Greeks, they're the so-called major Greeks and they're the minor Greeks. We're not even going to talk about the minor Greeks. That's just a level of detail that nobody wants. So let's talk about the most important ones.
Mhm.
And the most important ones for options pricing are delta, and that's the price movement of the options package relative to the price movement of the underlying asset.
Mhm.
Okay. So the delta movement in these instruments, in these buffered ETFs, matters a lot. That's a big one. The second big one is theta, which is just time to expiration. And so in options pricing theory, that time has value to it, and it can influence the price of the options package, especially as one approaches the expiration date. The theta impact on the pricing of what you hold can become meaningful at times. And then there's volatility, of course, which is used to price the options. And when market volatility is higher, the options package costs more.
Mhm.
And I'd say rho is somewhat interesting, and gamma is the second derivative of delta. So it's how responsive is the package to changes in the market and what's happening to delta dynamically. So all of these things conspire to have an impact on the NAV of these buffered ETFs that people hold. And my presumption is that probably no retail investor, or a very limited number, actually understand the way Greeks impact the pricing of their portfolio. And I even submit the advisors that sell them probably don't understand them to the level that they need to.
Mhm.
And that's why we created so we started providing research over a year ago, because we wanted to peel back the layers and help people see what was actually going on in these portfolios and what made one good and what made one bad, to help people sift through and become more informed and educated about what they own. So yeah, there's the short Greeks lesson.
So I want to just rewind and just remind our audience that the reason it's called the Greeks is because it's everything's referred to in reference to the Greek alphabet. So gamma, theta, rho, delta, those are letters in the Greek alphabet. So that's why we call them the Greeks. So that is just a good reminder in your mind. That's why we refer to everything as the Greeks, because a lot of these complex aspects of it's not even really markets. It's all really calculus. Like these are all, if you've ever taken a calculus class, this is just math. These are the same reference value names that complex math uses. So that's why we call it the Greeks. So let's start now with, if you're sitting with an advisor and they either currently use buffered ETFs or are contemplating using buffered ETFs, where do we start? What are the things that they need to absolutely know about? Because it's going to affect the client experience.
Yeah, I think so. Let's say you own one of these,
Mhm.
and let's say you bought it on the reset date.
Mhm.
And let's say you're 6 months in, and then let's say the market's been really moving aggressively and you've hit your cap. It's 6 months.
Mhm.
So in this thought experiment, if you're sitting on something that has no upside and only downside in it until the protection kicks in, why would you own that? Why would you continue to hold something that has no upside and has a large downside, so that skewed relationship to the downside with no return? Like, why would you do that when you could sell it? It's daily liquid. You could just go to the market and sell it and buy a money market fund
Right.
that would in 6 months give you some certain return with no downside and no risk. So the way they're structured to have that defined outcome period is a strength, but it's also a weakness. And market path, what we have learned in observing these and watching their behavior, is that no one knows the market path in advance. But when the market takes a path, it affects all of these instruments differently. And so you have to be paying attention, if you own these, to the path the market is taking and the specific payoff structures that are embedded in the options package of the instrument you own.
Yeah, and I think that's important because when we did our call before, when I was trying to convince you to come on the pod, because you had some reservations in the beginning, but it turns out we were on the same page. You talked about that. And I think that's something I always talk about, which is that once you hit that cap, all that upside, you're not protected. That's not part of your protection. Like if the market goes up 20, your cap is 10 and then comes down 15, like you haven't, like, your downside protection hasn't kicked in yet. Even though it's down 15 if your downside is maybe 10%, right? Because it's not actually down 15 from the defined outcome. And I think a lot of people miss that. And to your point, those things impact the underlying value of the buffer itself. And maybe that's a good segue into how these things trade. We know what the defined outcome is. And I talk about this all the time with advisors. But in the middle, everything that's happening with the price of that security is based on the market movements of the securities that it holds. So for a client, that can be unnerving because it might not feel like the defined outcome that they bought it for. And that can cause them to ask and push back and have questions. So let's talk about that. Let's talk about, we know what the defined outcome is. We know the issue date and we know the expiration date. And we know that if we buy on the issue date and hold to expiration, what our defined outcome is. But in between, which is the beauty of what you do and what you talk about, that's really the opportunity that no one talks about. And to be fair, most advisors aren't equipped to monitor them and trade them in a way to gain the arbitrage opportunity here. But let's talk about that, because that's what brought you to this place, was that you noticed it and you did, because you could manage it. So let's talk about that.
Yeah, so I think I did a blog post on this earlier. It's on our website, and it was titled something like, it's been over a year ago now, but it was something like, the market went down, but my buffered ETF went down. What happened? I thought I was hedged. So that experience for the individual client who bought one of those thinking that they had this very predefined linear protection, that's not the reality until the very last day. So what's going on in the interim? It's this dynamic where from time to time, you can get something that goes down when it's in its buffer zone and you thought it wouldn't go down at all. Like, why did I lose money? I thought I was hedged. And so there's a huge need for education on them with certainty. And I don't think it makes these bad de facto. It just means they need to be monitored and managed. And so if you get one of these and you're having that difficult client experience where they're saying, why is it behaving this way? I didn't think I bought something like this. That creates a challenge. It's into that confusion that we wanted to interject ourselves in the conversation. We did a number of things that were just kind of cool to prove that we had some insights. For example, we took a test account, and within one single laddered buffered equity structure, we can get into the ladders and what they do and how
Yeah, you have
they're,
some
and
cool charts, so I'm looking forward to that.
we had a test account where we traded only from among the 12 tickers inside of a ladder.
Mhm.
And we appreciably outperformed the ladder by just avoiding the things that were obviously impaired for some reason or another. They were capped out. They just didn't have the upside anymore. So you ignore those and you buy the ones that give you the better downside upside trade off.
Mhm.
And just with that experiment, trading from only a few inside of an offering of 12, we added huge value. And that's when we really knew, okay, we're onto something here. And it's what led to all of the analysis that ultimately resulted in us launching our own ticker to correct for what we think of as the engineering flaws inside buffers as a class. And I use the word flaw, and it doesn't mean they're terrible. So we've got some cool charts talking about what are the laddered strategies doing for investors. Why would they? What's so attractive about these? And I think the big takeaway from the 2022 period to 2023, you got significantly less market downside exposure in 2022 and pretty good upside participation in 2023 from the ladders, ignoring the individual ETF structure for a minute and going to a laddered ETF, which includes 12 of the underlying tickers, one for every month. Those handled that particular market path. And I always talk about path because path matters. If you look at how these things handled the taper tantrum last spring, it wasn't as good. we had more of an orderly sell-off in 2022 as compared to that 2025 event. So path matters, but in that particular case, there was a test case where most investors got exactly what they wanted, limited downside participation and pretty good upside participation. So I think that event kind of led to the industry being able to grow assets very dramatically, but it doesn't eliminate the problems with these instruments or the need to actively monitor and manage. So the safe solution is buy a ladder if you're going to stick with those traditional buffered ETFs. And it just might annoy some people that a third of them are materially impaired if you're investing in that and you just take it anyway. We wanted to engineer solutions that kind of got rid of all the major design flaws. So that's what we did.
So a lot of advisors don't ladder them, or their buffers at their core are derivatives. And when you think about other derivatives that are out there, futures and the like, you have to roll them. It's kind of a requirement. So you have to be paying close attention. To your point, sometimes it makes sense to start to roll and make decisions on whether or not to keep the position before the expiration date. Volatility matters, as you alluded to earlier. The price of options are inherently influenced by market volatility as a whole. In fact, they are in many ways volatility instruments, right? Their prices tend to really spike when volatility is high. Low vol markets are not good for derivatives if you're trading them actively and not using them as some sort of hedge or buffer, if you will. So let's talk about what a ladder is. You did mention that you would have one for every month, but when you're building your ladders, because as you said, you felt so strongly about this, you launched your firm with the goal of providing education, research, analytics, that kind of thing. And then ultimately realized that the vast majority of users of these products are not, maybe they could do it if they really wanted to, but it's a full-time job in and of itself. You can't do it on the side. It's not like a mutual fund or an ETF where if you don't touch it for a couple of days, it's not the end of the world. Some of these things are highly sensitive to daily movements. The fact that they have expiration dates that are often 12 months suggests that they have greater time sensitivity to something that you're going to hold for the long term. So let's talk about how that approach happened. You said, working with a firm that had these, and you started managing them. And as you've gone through the learning curve, how do you approach building ladders? What are the key attributes you look for? And how do you manage day to day the trading? What are the things you look for?
So
All that
what
kind
I
of
would
thing.
say is a ladder is one solution to the engineering flaws of holding a single month buffered ETF.
Okay.
Our solution is not a ladder. It's what we would call a rifle shot. But let's talk about the design flaws
Okay.
that are embedded in a single month expiration buffered ETF. And these things are by prospectus. So they're designed for a buy and hold single day outcome at the end of a year. Okay. So implicit in that is they're going to rebalance their option package in a predetermined way on one day a year. And there are 252 trading days in a year. So they're literally arbitrarily choosing one day out of a potential of 252 to rebalance that options package. And markets are dynamic, they're messy, lots happens. And so our view is, how many degrees of freedom are you giving up by limiting your fund to one day? So when we designed ours, we said, well, we'd kind of like to be able to rebalance on any day. So we have 252 choices when a typical buffered ETF has one on rebalance day. So in our view, that's a huge design improvement.
Mm-hmm.
Now, on top of this, when a buffered ETF is launched, the prospectus states the downside protection will start, 5% below the market or something like that.
Mhm.
So it doesn't start immediately. We said, no, we should be able to start the protection at 0, right under the market if we want to -5. We're going to have a range where we can start protection. Now, the other thing these things do is they're very explicit about the size of the buffer zone. They'll specify 10% or 12% or 15%. Sometimes they're very, very deep buffers. We've said we can range that from as small as 5, the buffer is 5 in size, all the way to 15. So we can start at 0 to -5, and we can go from -5 to 10 all the way to -20. That's in our prospectus.
Mhm.
So if you think of that buffer zone as being another form of degrees of freedom, by prospectus, these offerings have limited degrees of freedom, and we've tried to expand. We've tried to create maximum degrees of freedom. On top of that, instead of saying that we're going to have a 12-month outcome period and come hell or high water, we're holding for 12 months. We've actually said, no, we want to be able to buy our options package at a tenor of between 4 and 9 months. And we want to have the ability to move that around. And then finally, most of these have by prospectus a cost neutral cap, meaning that only the revenue they get from selling the put can they use to cover the costs of the package. And so they end up getting they're a price taker on cap. So at the time they recast when they rebalance on that single day, if volatility is really high and the price of the call, that'll affect the cap that they set on their buffer. So on the ETF package.
Mhm.
So they can end up with very limited upside if the rebalancing day was a bad one. And I call this like you know how you can have a good grape crop or a bad grape crop, and that determines if the wine's any good that year?
Yep.
That's the same thing with these buffered ETFs. If they rebalance on a bad month, that thing's going to be impaired for a long time. And I think the interesting data that comes out on these, and we have charts showing this, there are 2 instruments from inside the same laddered structure, 1 month apart, with a 12-month return difference over a 12% return difference over a 12-month period because they were reset 1 month apart. Now, there's 0 skill, and that just happens to be the effect of path and the rebalancing. So if you thought to yourself, these are identical, the buffer is identical, but one is 12% better than the other and it's not skills based, what kind of randomness are you exposing your clients to if you're just choosing one of these things?
Just because that happened to be the day that you wanted to look at buffers. I think you also bring up something that I really criticize our industry on is we have this desire, and unfortunately, the desire is matched by a demand for this from the investors who use these products to simplify things that aren't simple. And what
Yeah.
you're really pointing out is there's a lot of that happening with buffers, right? Like you have your cap and your defined outcome and all the stuff you're talking about, the degrees of freedom. The reason there aren't so many degrees of freedom is because that brings in complexity to conversations that make these things inherently more difficult to talk about. And I think that's where a firm like yours can be really useful. And this podcast can be really useful in terms of trying to help people understand that simple isn't always best, especially when working in complex products. And alternatives is my world. That's why I started my firm, because much like you kind of narrowed in on the buffer ETF need for education, understanding, and to bring to light that complex cannot be simplified without really giving up something important. And I think that's what led me to launch my own firm, is that there's value to these products. And much like in our first conversation, you're like, no, I don't hate them. You and I actually see eye to eye. I actually really like them because I actually think there's an arbitrage opportunity here for people who are willing to embrace the complexity. And that's very much how I feel about alts in general, is that
Yes.
l- yes, they're complicated. I can help you with that. I can't overly simplify a complex instrument though. And so we want to find ways to be able to discuss it so that we can set appropriate expectations with the end client without unnecessarily confusing them. And in essence, I think that's what makes what you talk about and what you're doing actually better. It's inherently more complicated, but it's actually easier to understand and communicate the expectations to the end client along the way, because then all of the movements that happen on the day to day are not red flags to them, right? I just really feel like the need to oversimplify a complex instrument actually leads to more questions, not less. And if you just embrace the complexity, you can actually better communicate and set expectations. And I think that's what you're doing.
That's right. That's exactly what we're doing. That was our goal, to assist in better understanding. And now the thing is, though, and I always like to go back to this, if you just ask, what have these things accomplished for people?
Mhm.
And you look at, say, the last 5 years, and you look at a scatter plot of the Buffer ETF against an S&P 500 index, you'll see that the Buffer ETF kind of produced a return of 9 with a vol of 9, while that's for a ladder over the last 5 years. And the S&P produced like a 14% annualized return with a 16 vol. And so that's actually a really, really strong equity environment in spite of what people may think of the past 5 years. And that trade-off is pretty good. 14 return for 16 vol. The long-term averages on the market are kind of like 10 with 16 vol, 10 with 17 vol. So the Sharp is something lower than what has been experienced in this recent period. But then if you go back to the long term on the stock market and you say you're going to basically get a 10% gross of fee return, generalizing, that's probably a pretty fair representation. I can remember George Russell saying that on Louis Rukeyser's Wall Street Week in the 90s. He said, it's about 10%, give or take. You can speak in those large spans of time casually when you're a renowned business person who's made it in the finance business. But if it's 10 and 17 vol on an unhedged equity portfolio, and you can get 7 and 8 vol or 7 and 9 vol, that's a pretty good trade-off for most investors. And that's why I think the buffered ETF structure is here to stay.
Mhm.
And our only question is, can we come in and engineer a solution that improves on the latter and gives people more of what they want? That's really what we're trying to do.
So let's talk
Address-
about that.
Yeah.
Yeah, it's funny when you talk about 10% average return with a 16% vol. There's literally an entire generation that's been in the business for almost 2 decades now that has no idea that that's true, because that has not been the case since the bottom of 2009. But for real, that's those numbers long term historically are spot on. We just have a generation that will say that can't be true. It is true. That
Mhm.
said, let's talk about what you're doing. You sent over quite a few charts, and I'd love to kind of walk through those and what you're doing and how you're able to game the system, if you will, because I think it's really interesting. And we'll start with compliance. Past performance is no guarantee of future results, but I think it's really interesting because there's a tremendous arbitrage opportunity for someone willing to do what you do. And most people can't. So they should look at BufferLabs as a way to really get the benefit of these products, but in the most optimized way.
Yeah. So again, we're engineers, we're empiricists, we're data scientists.
Mhm.
We're not trying to forecast the market direction, and we're not trying to position our fund to take advantage of a superior forecast. We are not finding mispricings in options and trying to trade them in a hyper velocity kind of way to make money. We are just saying de facto, when there is a gap inside of the instruments in a ladder that all have the same buffer zone and there's no skill, if there's a 12% return top to bottom gap over a 12-month period, there are ways to understand what's driving that gap and to not impute the gap, the downside experience, the worst of those ladders, the worst of the holdings in the ladders. There's a way to avoid that with superior engineering. And we don't know the market path. And so certain market paths treat different strategies better or worse. And you really can't know those things in advance. So our thinking is, hey, look, if buffers get capped out, let's make sure we can reset so we're not capped out.
Yeah.
If the downside is too far below our current position, let's make sure we can recast the options package to bring that stop loss up a little more tight under our current position. And let's do so with systematic rules and design features that compel us to rebalance when certain things take place. And so if you think, all right, most of the providers are specifying the buffer zone, and they're managing to that. They're managing to a 12-month holding period. They're managing to a structured outcome. If such and such happens, we can tell you with certainty on the last day, your return will be this. We're abandoning that. And we're saying, no, we're actually going to manage not to the buffer, but we're going to manage to the Greeks.
Okay.
So it's a design and engineering thing where we've just said, by actually designing and managing on the things that matter to the pricing of the instruments we hold, we will have a better experience on capturing more of that upside and at least equaling the downside protection you get from an unmanaged ladder.
So let's talk about it. You sent me some slides, and it's titled Making the Case for the Buffers. And in these slides, which I'm going to put up on the screen, you show a number of different combinations of buffers over time, 22 to 23, and then over time from 22 to today, of how the S&P is done versus some of these laddered buffered products, which are different than the buffers themselves because they're doing what you're talking about. And I think maybe this is a good time to think about, okay, let's start with that. What's the case for buffers, why you want to own it, and let's look at one of these time periods you sent over.
Yeah, so let's just take 2022, for example.
Okay.
In that year, and let's just look at the ladders. What are the ladders doing in 2022? You know, they're down, and these buffer instruments differ by the magnitude of downside protection they impute. So some are deep, some are what they call conservative. There are different words to describe how large the buffer is below the equity price, the current equity price. And so you can see that in that down market, at the margin, the deeper buffers protected more of the downside than the more moderate buffers. But all of them as a class kind of provided materially less participation in the market sell-off. So that's a good thing.
Right.
The question is, how much is that protection costing you in an up market?
Right.
So then you turn attention to 2023 and you look at those same laddered ETFs and what percentage of the upside they gave you in terms of participation. And no surprise, the more moderate downside protection strategies gave more upward lift or more upside amplitude than the more protective ones. And they all did participate. So we looked at that and we thought to ourselves, what do markets do over the long term? And academics call it a random walk around an upward drift.
Right.
So they're random, but there's a drift to it. There's an upside bias. These are loaded dice in the favor of the investor. So if that's true, and we want to provide downside protection. Shouldn't we be trying to maximize our exposure to the upward drift embedded in the random walk?
Mm-hmm.
So we want to make sure that as markets go up, we're not giving up too much of the upside. So that's a design principle embedded in our approach to do as well in downside and do better in upside markets. Because really, there's nothing worse than having a risk exposure that goes unrewarded. And our thinking is through those design features I talked about earlier, that we will be giving our investors more exposure to upward drift than if they went with a ladder. And in particular, if they went with a single month buffered ETF. Those things in an upward market are going to get capped out. And the give up is on the upside, actually.
So one of the other charts you gave were basically a ladder every month of a set of buffers for the last roughly year. And you can see the price change. Now, what I don't have here for context is the caps on these. So I can see, generally speaking, what the performance is. And what stands out to me, for example, is March and April were obviously not great months, just based on March, April, and June are the outliers in performance by far.
On the downside.
On just the overall return. So I don't know what the caps are, right? So I don't know if the cap on these things is 10% or whatever. But I also see the vast majority of these on the other months are around 13%, right? If the cap's 10, you would want to be selling these right now, right? If the cap is 10 and they're up 13, you want out of there.
That's correct.
Now, because you can actually capture the 13 today versus if you hold till expiration. Is that correct?
Yes. Now, the problem is that creates a tax event
Yes.
for investors if it's a taxable account. And that's another thing we were engineering for, is that all of the rebalancing we're doing inside of our ticker does not result in taxes. So we're able to capture that upside and reset our options package without sending clients a taxable distribution, which is huge.
Yeah. So let's talk about it though. Like when you look at these opportunities over time and you're building out, what's your alpha mechanism? What are you doing to capture some of this? And then how does that kind of play out over time?
Okay. So let's just imagine, like, we have some data in there that shows a July reset versus to an August reset. July did not have a volatility spike and August did. So that August instrument is like that bad grape year for wine. They're rebalancing in a high VIX environment, which means they're going to get a much smaller cap. They're going to be impaired for a year because they had to buy a lower cap. They had to impute a cost on the cap that brought it way down. And so we're looking at that saying you should never buy or hold something that had a bad rebalance day, just owing to market features. That's not saying this is an unskilled outcome. This is saying this is a design flaw outcome. And so let's not have that design flaw. Let's not have our rebalance subject to 1 day a year. Let's open it wide so we can rebalance any day.
Right.
And now we haven't done this, but we've toyed with, you could actually take all possible trading days over, say, 20 years, and then you could score those trading days in the context of a buffer rebalance. And you could say which days were top decile for rebalancing for a good outcome and which days were bottom decile, and creating a model that allows you to score the day. So, hey, buffer whatever rebalanced on October of whatever was doing so on a really good day or a really bad day.
And define really good or really bad. Is it just the VIX, or are we looking at other underlying volatility instruments?
It's pretty much VIX. I mean, you could say it's volatility surface, and we could have a really nuanced conversation about modeling volatility surface beyond standard options data or market volatility data. And we've done some work in that regard. But the reality is you get the vast majority of the impact by just looking at VIX.
Okay. So basically you could over time analyze, what the VIX block of numbers, right? Like what
Mhm.
your the span of when VIX is in this range. That was the word I was looking for, range. This is typically a good time to rebalance versus when VIX is at extremes on the curve. Those are bad days to rebalance. And you
That's
kind of
right.
know because you have enough data in your sample, you know, where those extremes sit, correct?
That's right.
Yeah. And I would also assume that you could probably also do some correlation um, that would show that as well.
Yeah, there's no end of analysis you could do of the VIX days. And I think for an investor, and we may put this in our research reports, we could just say, hey, on the last day this thing rebalanced, how does it grade out? A through F.
Uh-huh.
Was it an A day or was it an F day? And why? We think that would be really helpful for people if they could just go, oh, for the current year, this thing's getting a bad grade for its rebalance day. And it's not going to be a good instrument because of that.
So let's talk about your offering, and we'll put the
Yep.
ticker in the notes. And for compliance purposes, we won't say it. But let's talk about when you launched it, how you've been approaching it, and sort of how your thesis all along, because prior to launching the instrument, you were doing the research, you were monitoring it, you had managed these portfolios before, but you can have a thesis of how this will play out in a different structure with larger asset bases. But how has it gone so far?
Yeah. So interestingly, and this is through last Friday, I haven't updated it since then, but we were actually, since our launch date on October 8th, we were actually a few basis points ahead of the underlying SPY.
Mm-hmm.
How do you do that with with a product that has insurance inside?
Mm-hmm.
And it's random. It's a function of the path the market has taken. So the market took a path that has been, let's call it tepid and a little bit challenged, a little bit sideways at certain times, and kind of making gains, giving gains up, that kind of thing. And so if if you look at the particular path we've taken, it's going fine. Now it's interesting to me that we're actually lagging not all the ladders, but some of the ladders and some of the bigger ladders out there. And it's because we have an undifferentiated market environment. Nothing's capping out right now, or the vast majority isn't capping out because the market's kind of stalled and going sideways-ish. It's a far more normal environment. So we are from October 8th, we're about 4 months into this, and we're up about 3%. And so in the underlying market, that is. And so if the market's up 3 over 4 months, it's going to be up under 10, which is nowadays that's been rare, but you're underneath caps of a lot of these buffered structures. And so when they're not capping out, the ladders look fine. It's only when you get a market with more upward drift.
What about highly volatile markets where you can take advantage of how volatility affects the underlying option prices, where maybe the market itself its return is irrelevant, but if the VIX spikes and volatility spikes because of some geopolitical event or tariffs or a tantrum of some sort, is there an opportunity there? And how would you handle something like that in the way that you manage this portfolio?
Yeah. So, our unwritten rule, well, it's a written rule actually, but
It's in the prospectus.
it's not in the prospectus, but it's the way we're thinking about our package of options, is that we have a number of days where the delta is below X. If we get 5 consecutive days where the delta is below X, we will rebalance.
Mhm.
But we don't have to, and it does depend upon our assessment of ambient market conditions. So if we're in a vol spike and the market's selling off, when you're in vol spikes, you usually have some downside shock. Usually you want to just hold your options package and let the market heal, let the theta impute, and find a better time to recast when volatility is moderating. So during the shock is typically not the time you want to rebalance. You want to have a steady hand in that case. Now, if you talk about the volatility of volatility, and you
So
want
that's is that rho? Because I know is volatility is sigma, right?
Rho's interest rates, the
Okay.
vol of vol's gamma.
Oh, there you go. And sigma is vol, right? But little
Delta.
sigma, not big sigma, right?
You're just trying to react to the vol of vol. So all, it's never all else equal, but if you're needing to rebalance or wanting to rebalance and you're looking at the vol structure of the market, you might say, hey, it's high right now. Let's only commit to a 4-month tenor we can do by prospectus between 4 and 9. We might take a shorter view and say we're going to get a better chance. We're not going to buy a longer dated option package and have to deal with that. We're going to take a short one and redo this because we think shorter is better in a vol spike.
Okay. We've jumped into the Greeks and we've taken our audience on a bit of a ride here. And I'm sure some people are still like, wow, this is really complicated. And in essence, I actually want that to somewhat be what our listeners leave with, is that this is complicated and you have been sold a bill of goods that tries to simplify what is inherently not simple. And I want your eyes to be open to that, because that is what has always been my big thing with buffers, is that, look, I don't like them because I think they're inherently misused and sold in a package that's pretty, but doesn't actually capture the complexity. And because of that, you're setting yourself up for questions you can't answer and a client experience that could be suboptimal. As we wrap it up here, I want to leave our audience with a couple of things. The first thing is, if you were evaluating buffers, if you're a financial advisor and you really like them, if they were to take a step back, what are the 3 or 4 questions that they should get in the habit of asking every time they evaluate a buffer?
Yeah, your point that they're making simplifying assumptions and simplifying language to help people invest and feel comfortable. I would say don't do that. First of all, don't do that. Have a eyes open conversation about what's actually inside, and that there can be periods where these things do things that maybe you wouldn't expect based on the way they're presented. And so have a very above board conversation that these are options packages and they do certain things. And while it is true that if you hold them to the very last day, you will get an outcome that can be predefined. You can't say where the market will be, but you can say if the market does X, then these will do Y. Like you can say that, but the price of doing so is just so very, very high. And there is a better way to do it, especially if you're in an instrument that provides you with daily liquidity. Why would you not take advantage of the ability to trade these and position yourself in something that gives you more of what you want instead of less, which is more downside protection, more upside participation, more intentional downside protection, more intentional upside participation. That would be what I would want people to be left with. This idea that they're simple and easy is not true. I'm reminded of, I don't know if you back in the day ever met with Jacobs Levy, Bruce Jacobs. He said something that has stayed with me for many, many years. He said, Eric, for every complex problem, there is a simple solution, and the simple solution is almost always wrong because complex problems require complex solutions. And that's really, if there's a pithy phrase for what we're trying to do here, It's we're trying to understand the complexity with math and tools that help us do it better.
Yeah. I actually love that. That's an absolutely fantastic, just general way of approaching these things. Because again, I think our industry and a lot of advisors, I think, want desperately to find simple ways to explain complex things because it makes their job easier. But I would implore advisors to think about the value they add here is in managing the complexities and being open about them because you don't have to go down the rabbit hole like we just did for the last hour of
No,
all of this conversation with your client, but you should have them understand that this is complex and that's why they hired you, and give them some expectations of what the ride's going to feel like. And I think ultimately that's what advisors and their clients want. The reason people are so attracted to defined outcome is because it's defined. But the reality is everything every day in every minute that we live is completely unpredictable. It tends to go the way we think, but not always. And every aspect of your life is like that. And whether we're talking financial markets or we talk about just life in general, I always like to say, I was going about my life just fine. And suddenly, a Saturday morning, I got a phone call that my partner was dead. He just didn't wake up. And then, okay, I absorbed that wasn't a good day. Didn't see that coming. A couple months later, all of a sudden, here I was perfectly healthy, never had any serious health problems in my life, never had any physical ailments, nothing. And oh, by the way, you have a broken back and you have breast cancer. And that literally happened in a week.
hmm
So, as much as we want so badly to understand like what's going to happen tomorrow or the next day or whatever, there's something quite freeing about just accepting that we have no idea. And
yeah,
in a way, that's what we're doing here with buffered ETFs is
for sure.
in
You know,
reality, we're just accepting that like we have a general idea and there is a potential we can have a defined outcome or we can do it better and give up that defined outcome knowing what the underlying return expectation is and what the ride will feel like. Because to
yeah,
get a defined outcome, the ride is unpredictable.
the human experience is the world is chaotic. And what human beings try to do is they try to create the perception of order amidst the chaos. That's why all of our houses have four walls. They're
Right.
square, they're, very neatly put together to give some sense of order. And I think the human need for order is so high. That's really what these buffered ETFs are addressing, the desire for order from chaos. And what you and I have been discussing, and by the way, I'm sorry to hear about all those things that you went through. That's absolutely terrible. And yet you're acknowledging that is life. It's unpredictable, it's chaotic, it's not orderly. But the human desire for those things is so great that a product like this gets traction in the marketplace
Mhm.
for that very reason, order from chaos.
Yeah.
And I guess what I'm saying is the world's a little more chaotic in these buffers than the marketing literature would lead you to believe, but they still do something important for people. They still meet that need to have less volatility for certain kinds of investors. That can be the thing that allows them to amass more wealth. Because if they didn't have that guardrail, they might sell the market at the bottom and make all kinds of
Yep.
mistakes. So they aren't terrible. They serve a purpose, but you have to manage them and you have to be thoughtful and you have to get as much data as you can possibly get to understand them as well as you possibly can.
Well, I'm really glad that we now have a resource like BufferLabs. Why don't you tell our audience where they can find more information about BufferLabs and what you guys are doing?
Sure. And we haven't brought our research online from the time we got licensed with the SEC for our ETF,
Mhm.
but we will be bringing the research reports back online. That's at www.bufferlabsetfs.com. We're launching some universe data. We have an index on there that we're maintaining. There's good information. And then our fund itself is www.bufferletf.com.
Awesome. And I will put those links in the show notes. I'll also put a link to Erik's LinkedIn page. Erik is always posting really good information on this topic on his LinkedIn feed. It's actually what led us to have this conversation. It's what led me to want to have Erik on the show, because he would post that stuff and it would trigger me. Because every time I see anything buffer related, I get triggered. But then I started reading it and thought, wow, this is good stuff. And there's no one else doing it. So I'll put that in the show notes as well. I just want to thank you so much for coming on. I know it's been a long time, but it's been awesome catching up, hear about what you're doing. And I particularly love the mission of what you're trying to achieve here, because it's not so unlike my own mission.
Really great. I wish you all the best as you build out your company. I'm hoping for the best for us. And what I would say is, if the chance happens for me to come on a specific event that is interesting in the buffered space, I would love to do that. It's a standing offer.
Awesome. We appreciate it. And I want to thank our listeners for tuning in to today's episode. We're happy to have you here. We hope you walk away with a better understanding of buffer products. And I will admit that they do have a time and place. But if I were going to do buffers, I would want to do it your way. And I am not skilled enough to do it. So having someone like you out there is exactly what we need. As always, please like this episode, subscribe to our podcast wherever you may find it. Leave us a review. We'd love to hear what you think of the show and what we're doing. If you have a topic or a guest that you think we should have on, let us know. We'd appreciate it. With that, I am Shana Orczyk Sissel, the founder and CEO of Banríon Capital Management, and this is What's the Alternative?
Let's go boom.
The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Banríon Capital Management's platform. As such, Banríon may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Banríon Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Banríon Capital trademarks mentioned are owned by Banríon Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.